You want to purchase shares or stock of a given company. How do you know if a given share or stock is good? Good is subjective, yes, but there are key things which you can check for you to know if it is good for you, because also good is relative. Something might be good for you and it might not be good for me. That's why in this video, I want to share with you 7 signs that you can use to know if a given stock is good for you. Watch the whole of this video for you to appreciate, absorb this knowledge that you can utilize when you are making decisions in the stock market to purchase shares of your favorite companies or even companies which are listing new in the stock market. You are all much welcome to my channel. My name is Apagza Sifuna. In case you are new here, please consider subscribing to this channel. Subscribe because I'm bringing you amazing finance videos each and every day. And while you still at it, drop a like on this video. And in case you are a stock investor or are planning to buy a stock, just comment down below which stock or shares of which company are you planning to buy and why. Drop a comment down below. Let's continue discussing them. Having said that, the very first sign of a good stock is you understanding the business which underpins or propels a given share. You know, this is something which most people out there overlook. Maybe they just hear, hey, BAT does pay good dividends, okay? Maybe Standard Chartered Bank does pay good dividends. Last year they paid 14% dividends, okay? Maybe KCB is doing 1, 2, 3. They don't really take time to understand the business. The best way you can give yourself confidence and avoid making decisions based on emotions is by you understanding the business. Whatever you want to put your money down on, that particular stock you want to purchase, do you understand the business that the company takes part in? Case in point, if you go ahead, for example, and buy, I'm just giving an example, nothing specific to this particular share or stock. If you want to go and purchase, for example, shares of Everready, do you understand the business of batteries? Do you understand the evolution of batteries, the different types of batteries, lithium batteries and other batteries? Do you understand? Or you gotta just be purchasing blindly because a company has a good name, or someone has told you maybe this company might be good. Don't just make a decision based on naysay. Understand the business. If you don't understand right now, fair enough. Invest in learning, because all of us were born with an empty slate and we absorb knowledge along the way. So spend time to understand the business which you want to invest in so that you have the confidence to invest. And confidence is important because if you invest with confidence, you'll hold their stock or shares for a long time. You won't panic sell. You won't make decisions based on sentiments in the market. You will be calm and collected and sure about the decisions you've made, okay? And then the second thing you need to look at is earnings growth. Is the company consistently growing in earnings? Unfortunately, a good chunk of people out there do purchase shares or stock of companies without understanding the company earnings. The best case scenario for you when it comes to earnings is looking at consistency. Has this company consistently made profit, okay? And even beyond that, has this company consistently grown over the years? In case the answer to these 2 questions is yes, chances are your segment of decision making when it comes to earnings is very well informed, because the company is making profit and the earnings are growing year in, year out. That tells you they're going to be able to meet their obligations and also even partly pay you dividends if it comes to that. And then the third thing you need to look at is look at cash flows. Cash flows of a company tell you a story. Because whether it is companies or individuals, cash flows is king. Basically, people tell you out there, cash is king. There's a reason as to why that's the case. Just as individuals, if a company is strapped of cash, how can they fulfill their obligations? How can they expand? And unfortunately, in case they're not making money, how also can they be able to flip to get a profit to even share that profit with you as dividends? It means they're going to be constrained. They're going to be constrained of cash, and chances are they're going to be constrained of their ability to make profit too, in case they're relying on cash for them to make any margins. So look at the cash flow statements. And the amazing thing is that all this information is public. when you go and look at any company's annual financial reports, they typically have three key records there, which are important. There is the balance sheet, there is the income statement, and also the cash flow statements, which the cash flow statements talk about the liquid cash these companies have at any particular point in time, the plans they have on these, and even notes for the previous financials as to how or what happened to their cash flows. That is going to inform you as you are making a decision to purchase a given stock or a given share or not. Because if a company is not making profit and is not growing, their strength of cash flow, then which miracle are you banking on that their stocks or their shares are going to increase? Okay? And then the fourth indicator you need to look at is manageable debt. This is something which most people out there do ignore. Case in point, a company could be having maybe a profit of maybe last year, a profit in their cash flows, even assuming they are equal, because they're really not equal. Maybe let me say it is maybe their cash. Of course, at the end, the cash flow statement needs to balance to zero. But assuming this company has an income of maybe let me say 10 billion, okay? That amount on paper looks very huge. What if their debt is 80 billion? Does it mean the company is healthy? Or would you rather invest in a company which, for example, has income of 1 billion and they have debt of only 30 million? Maybe the second company is a better option for you in case the first company is going to struggle to repay the debts they have. That already will be an indicator of them struggling in the near future. That's why you need to be looking at debt ratios as you also make a decision to purchase a given share or a given stock of a company or not. Don't just purchase blindly, because a company's current debt tells you a story about their potential for the future to repay the debt or even so to struggle. And guys, that is the fourth thing you need to look at. Companies need to have manageable debt, not runaway debts, because if you put your money down, your money is going to end up being consumed by paying debts, okay? And then the fifth thing you need to look at is durable competitive advantage. The company you intend to purchase shares from, does it have competitive advantage right now? And even beyond that, is their competitive advantage a going concern, which speaks to durable competitive advantage? Case in point, I'm not saying that's the best investment for you, but if you're purchasing, for example, shares of Safaricom, Safaricom has a number of competitive advantages. For example, M-Pesa. M-Pesa is here to stay because that is driving economies in Africa, okay? The mobile money transfer, and M-Pesa is the dominant mobile money transfer platform in the country. Secondly, Safaricom is very big on data, on internet, and also Safaricom is very big on business enterprise solutions. These are real, tangible, competitive advantages, which is going to take other companies very, very big hassle or hard work to offset Safaricom because of its market leadership and having solidified its space in these areas. That is a real competitive advantage, which is the fifth thing you need to be looking at for whichever company out there. Just because, for example, a company has listed, it is in the service industry, you are not really picking exactly what its competitive advantage is. Chances are that company might run out of business in the near future in case the competition becomes very dire. But if it has a distinct competitive advantage, then chances are that company is going to survive economic turmoil, is going to survive competition, and that is what you are looking at when you are choosing a company to put your money down on. And then the sixth thing you need to look at is shareholder-friendly management. Look here, guys. Are the managers of that particular company, are the directors shareholder-friendly? And by that, I mean, are they, for example, sharing information openly in reports regarding the company affairs? Are they, for example, acting in the best interest of shareholders? And I'm saying so because companies have a mandate of them improving shareholders' wealth. So the managers, and also by extension the directors, are supposed to be acting in the best interest of shareholders. So are they doing so? Or maybe are the managers of a given company constantly in scandals, right? Are the managers of a given company hiding information? In case that's the case, chances are these managers are not shareholder friendly. And that in the midterm to long term is going to be a very big problem because you are putting your money on shares of a given company. You're going to be banking on two things: share appreciation, and potential for dividend. So, if the managers are scandalous, chances are share appreciation won't happen because the market is going to be reacting to perception. If the perception is negative, you'll end up losing your capital. And if the company is constantly in turmoil, also they'll be losing business behind the scene, meaning the chances of making profit or making a big profit to share with shareholders is going to be close to nil. Also, it's going to be speaking to you, probably not gaining from any dividend payout. And that is going to be a very big risk for you. That is why shareholder friendliness when it comes to management is very important. And then the seventh and last thing, which I think is important, is you looking at company valuation. And a reasonable valuation is key to informing your decision making if you want to put money down on a given share or not. By reasonable valuation, I mean this. You need to analyze and understand, is a given share of a company overvalued or undervalued? In case, for example, it is overvalued, maybe at the point of you purchasing, you purchase the share at maybe 30 shillings, okay? If it is overvalued, the market forces of demand and supply and also information flow dictate that over time, they're going to be price adjustment. And if price adjusts to reflect the reality, the price of a particular share or stock is going to go down. If it goes down, you'll end up losing your capital because your capital will have depreciated instead of appreciating. That is why, beyond just the noise in the market, beyond what media publications out there are saying, do some little valuation to understand, is that share overvalued or undervalued? It is better for you to purchase a share which is undervalued or is accurately valued. That way, you have an upside potential as opposed to you purchasing a share of a company that is overvalued, because chances are, over time, price correction and price adjustment is going to dictate that you'll end up losing your initial capital. Guys, what do you think about this video? Do you think these 7 ideas can assist you make informed decision when you're purchasing a share or stock of a given company? Comment down below. Are there other things which you typically look out for as you are making that particular decision? And also, if this video is useful to you, comment down below indicating it is very useful to you. Let's continue discussing, and I'm going to keep up bringing you and making you amazing videos around matters of money and investments each and every day. Cheers, guys, and you all stay safe.